13 million people recently paid a tax penalty they didn't even know existed, and many tech employees are quietly losing thousands every year because of this tax. After reviewing tax returns from many high-earning tech employees, I found that most of my clients were paying this unnecessary tax penalty before we started working together. So in this video, I'm going to show you what the hidden tax is that hits tech employees the hardest, the proven method to avoid and remove the tax penalties, and I'll even show you how to automate it so you don't have to worry about it ever again. To start, let me show you how this hidden tax is slowly ruining tech employees. Would you trust a kid with a bag of marshmallows in the morning, telling them to hold on to it for dessert at the end of the day? When you show up to make dessert later in the day, most kids will probably hand you an empty marshmallow bag. Now swap the kid out for you. The government doesn't trust you to hang on to your money until tax time. They think you'll spend it before April 15th. And honestly, for most people, they're probably right. But even if they did trust you, they don't want to wait that long. So they set up a pay-as-you-go system. Unfortunately, most people don't realize this until they're filing with TurboTax or their CPA. By then, it's already too late and penalties have kicked in. Here's how to find out if you've been hit with this sneaky penalty so you can get your money back fast. Have you ever looked in the mirror only to realize that you've had a huge hunk of spinach in your teeth since lunch? You've been walking around smiling at everyone and nobody said a thing. Let me give you a mirror check showing you how to uncover the food in your teeth. So here's what I do with new clients. I dig into their tax returns from the past few years. Doesn't matter if they've earned $1 million or still early in their careers, so many have had this tax spinach stuck in their teeth for years. And nobody's going to point it out. But trust me, it's way more painful than a little embarrassment. It's cash gone. So here's how to check if you've paid it. Pull up your 1040, that's the main tax form everyone files. Flip to the second page, look near the bottom for a line called Estimated Tax Penalty. If you see an amount greater than 0, you've paid this penalty. If it's 0, don't get cocky. Next year could be different. But did you know that you may not have to pay that tax penalty at all, even for previous years? Let me show you how you might be able to get back some of that money. Imagine if you could go back in time and remove the spinach from your teeth long before the embarrassment, like it never happened. Here are the steps you can follow to save you thousands of dollars. The IRS offers ways to remove or refund certain tax penalties, a process called penalty abatement. But where can you start to request a penalty abatement? For the first time ever, I'm finally releasing a quick copy-paste penalty abatement script so you can quickly contact the IRS and potentially knock off thousands off your tax penalties in just a few clicks for free. Link in the description. And if you've already paid a penalty in the past few years, don't worry. There's one more strategy to avoid or reduce your penalty, even if you're late and incurring penalties as we speak. I'll explain this at the end. But first, let me show you how to easily calculate your estimated taxes so you can avoid them for good. I want you to think about how you pay your utility bills. Some people have a flat rate subscription like a gym membership or a fixed rate mortgage. You pay the same amount every month, no surprises. Other people have bills charged every month like your electricity or phone bill, depending on how much you use. When it comes to estimated taxes, the IRS actually gives you both options. Option 1, the regular installment method. This is like a flat rate subscription. You make 4 equal payments over the year using Form 1040. Most of this is already withheld from your paycheck. It's predictable and it works best if you have steady, consistent income like a salary or pension. It's easy to budget and plan for, but it doesn't adjust if your income goes up or down. Here's an example on $100 worth of income. The withholding for Q1 is $22, withholding for Q2 is $22. Every single quarter is $22. Option 2, the annualized installment method. This is more of a fluctuating utility bill. Your payments change based on how much you earn each quarter using Form 2210. This will be 4 separate unequal payments from your bank account. It's designed for people whose income isn't steady. Think of salespeople on commission or tech employees with bonuses, NSOs, or big stock sales. The good thing about this, you pay more when you earn more and less when you earn less. On the bad side of things, it does take a little more effort to track your income and calculate each payment. Example, on $100 worth of income. Q1 is $22, Q2 is $22, Q3 is $35, and Q4 is back to $22. Next, I'm going to show you how to make these estimated tax payments and how to automate it so you never have to stress about it again. Let's say that you earned $100 in Q2, April 1st through May 30th. Your company withheld 22%, totaling $22. But because you're in the 24% tax bracket, you need to pay the difference of $2. But how can you automate this? As a business owner, I have paid these taxes for years and will now show you. So let me pay some of mine right now in 15 seconds. Go to irs.gov/payments, select direct pay with bank account, select pay individual tax, then make a payment. The reason is estimated tax, select 1040 ES current tax year, and verify your identity. To help you calculate this, you can start by hiring a tax professional or start with my spreadsheet in the description. Here's how you can automate it so you'll only have to do it once instead of trying to figure this out 4 times annually going forward. Don't pay through the IRS, but pay through the bureau that's over the IRS, the US Treasury. You're going to start by going to eftps.gov, enroll as an individual. Once you get the PIN, log in and set up and schedule payments. But automating the payment isn't enough. Most people fail right here, including many tax professionals, because they're reactive with their taxes. But as a proactive, forward-looking tax planner to the wealthy in tech, let me show you the tax planning hacks that could help you minimize or completely avoid your estimated tax penalty. Imagine enjoying a meal at a restaurant and receiving the check, only to realize you didn't bring your wallet. Please check to see if you have your wallet before the bill comes due. Check before you even leave the house. But how do you do that with estimated taxes? Here's how you do it. First, you want to get a copy of something called Form W-4, which simply tells the government and your employer how much to withhold from your paycheck. You can download Form W-4 from irs.gov or get it from your employer. Complete steps 1 through 2 as usual. Enter your personal info and filing status. If you previously claimed a dependent, lowering or removing that amount will increase your withholdings. In step 4C, add an extra dollar amount to withhold per paycheck. Give this updated W-4 to your payroll person at work. Then on your next paycheck, ensure that the new withholding is reflected correctly. Update again if your income or tax situation changes. Here's another IRS approved method to avoid penalties, even if you end up owing more than you withheld. It's essentially a get out of jail free card. The IRS says if you pay at least 100% of last year's taxes or 90% of this year's actual tax, you're protected from penalties, even if you end up owing more. This is called the safe harbor method, and it's just the safety net to protect you from penalties. It's not your actual liability. From a planning perspective, compare the 90% of this year's tax return and 100% of last year's tax return and pay the smaller amount so you're not locking up more money with the IRS. Here's another IRS approved hack if you missed the fourth quarter January 15th deadline. There's a little known 2-week grace period to stop the penalty clock. You can even completely avoid paying fourth quarter estimated taxes through this hack. You unlock this by paying your whole tax bill by January 31st, but this can be difficult if you haven't received all of your tax forms by the end of January. Let me show you how this next IRS approved trick works. But first, you need to understand a little quirk about the quarterly estimated taxes that make it way easier to forget about. One would think that quarterly estimated payments would be in 4 equal intervals of time, but that's not the case. Q1 is due April 15th, which is the regular tax deadline. Here's the 1, 2, 3 month trick to remember the other days. From April 15th, you skip 1 month and land on June 15th. For the next payment, you skip 2 months, July and August, and land on September 15th. And lastly, you skip 3 months, October, November, December, to land on January 15th. With that understanding, let me show you how I'm planning with a current client to save them an estimated $13,400. I have a SpaceX client that was about to trigger $1 million worth of taxes right around June. Rather than exercising his incentive stock options May 30th, I told him to delay it by a single day. That way, his estimated taxes wouldn't come due for another 3.5 months. Due to interest rates and other tax strategies, my client and I estimate this will save him around $13,400. Of course, results will vary for you and my clients. But if you have seasonal income and are self-employed or working on commissions or have stock options, you might consider influencing the timing of your income. This last IRS-approved method for avoiding estimated tax penalties is a bit of a Hail Mary if you found yourself behind on your tax payments. With your last few pay stubs of the year, you can sometimes eliminate or reduce your penalty entirely if you increase withholdings on the last few pay stubs. This works even if you've been accruing interest all year long. The reason this works is because the IRS views withholdings to be made evenly throughout the year, even if most of the withholding happens at the very end. You'll want to work with your tax professional on this. But first, a word of caution. A young multimillionaire Tesla client of mine was keen on out-investing the penalty. I helped him understand that he had to get a solid return in the short term, which is both extremely difficult and risky. It's not worth it. Don't try to out-invest the penalty. Another word of caution is knowing which income needs extra attention. The biggest surprise will come from things that don't have withholdings, such as employee stock purchase plans, incentive stock options, alternative minimum tax, and stock sales. But even if some of your income already has withholdings, such as non-qualified stock options, restricted stock units, bonuses, and so on, you still might need to withhold more based on your tax bracket. Which brings us to the next big problem. Avoiding taxes is great, but there are clearly 3 particular things that are way more important than minimizing your tax bill. Let me show you what they are and how I use a framework to make smarter financial decisions faster for some of the world's brightest people with Harvard degrees to SpaceX engineers. Click here to watch more.